In January of this year, gold was touching near 5,600 US dollars an ounce. People were calling it unstoppable.
Right.
But today, it is clinging to the 4,000 US dollar mark by its absolute fingernails. And the market is just holding its breath. What actually happens when the world's ultimate financial safe haven suddenly stops feeling safe?
It is a brilliant question. Welcome to our deep dive into the gold and silver market news bulletin for the 30th of June, 2026. If you find this analysis helpful as we get down to the brass tacks of the market, please take a moment to like the video, subscribe to the channel, and leave your opinion in the comments below. We genuinely read every single one.
We really do.
Our mission for this evening is straightforward. We need to make sense of a wildly volatile trading day where gold is fighting to survive at a major psychological boundary. We are going to determine whether what we saw today is a bull trap or, a genuine buying opportunity for you.
And it is a very tricky environment to navigate right now.
It certainly is. So to help you navigate this, I am joined by our expert guide, senior market analyst, Dr. Khalid Al-Nuaimi.
Thank you. It is a critical time to be analyzing this market. The structural shifts we are witnessing right now in precious metals are breaking a lot of traditional forecasting models.
Breaking models is certainly one way to put it. Let us get straight to the timeline of the June 30th market roller coaster because, the intraday volatility was just staggering.
It was incredibly violent.
Right, so we need to establish the immediate factual context before we zoom out to the macro picture. Overnight, gold hovered quietly around $4,010 to $4,020 per ounce. But by the morning trading session, the floor completely gave way.
Just dropped entirely.
Yeah, we saw a plunge down to $3,950, which triggered widespread panic across the retail boards. But then it violently reversed course, pushing back up to $4,040 by noon, before settling back into a tense tug of war right around $4,010.
Exactly.
And we both know this bounce back to $4,040 has all the fingerprints of a purely technical recovery. Computer algorithms hitting pre-programmed mathematical support levels rather than any fundamental shift in human sentiment.
Spot on. The footprint of algorithmic trading is definitely all over that morning reversal. When an asset drops sharply to a round number like $3,950, it triggers automated buy orders.
Just machines waking up.
Right. Algorithms that institutional funds have just left sitting in the order books. The speed of the bounce confirms that those algorithmic buy walls exist. But you are touching on the more important point, which is human sentiment. The fact that the price was immediately rejected at $4,040 and pushed back down shows that human discretionary traders use that bounce.
The actual people making choices.
Yes, the people making active, fundamental choices use that algorithmic bounce as exit liquidity to close their positions. There is just immense underlying bearish pressure right now.
Looking at that $4,000 resistance line, it acts a bit like a pressure valve in a massive industrial plumbing system.
That is a good way to look at it.
The market is testing the valve. If that valve breaks completely, we are going to see liquidity violently flush out to the downside. But if the valve holds, the downward pressure eventually exhausts itself, and the fundamental buyers might return.
And we are seeing a slightly different story with silver.
Yes, interestingly, silver seems to have a slightly stronger valve right now. Silver faced a similar plunge today, dropping from $58 down to $57 per ounce, but it recovered much more aggressively than gold, pushing back to nearly $59.
Silver is currently benefiting from a structural advantage that gold simply does not possess in this specific economic climate.
Which is what? Exactly.
Well, silver is a monetary metal, yes, but it is fundamentally an industrial commodity. As the global push for renewable energy infrastructure continues, manufacturers who require physical silver for solar panels, complex electronics, and medical devices, they're using these price dips to secure their supply chains.
Oh, I see.
When the price of silver drops to $57, industrial procurement managers step in. That physical, real-world utility provides a hard floor for silver, whereas gold relies far more heavily on monetary sentiment.
Right, which brings us to the broader forces dragging that monetary sentiment down. The context for gold right now is undeniably grim. It is down roughly 12% in June alone.
A very heavy drop.
We are looking at the fourth consecutive month of decline, securing the worst overall quarter since the second quarter of 2013. We have watched it bleed out from a staggering high of nearly $5,595 in January, all the way down to this $4,000 support line.
And the primary force crushing gold right now is the monetary policy coming out of the central bank, specifically the United States Federal Reserve.
The ultimate villain of the piece for gold investors.
Truly, financial markets are currently pricing in a dominant 65% chance of another interest rate hike in September. Furthermore, 10-year Treasury yields are sitting exceptionally high, currently at 4.396%.
And we know how that opportunity cost mechanism works. Gold is a static piece of metal. It pays no dividend and yields no interest.
Exactly.
If the government is offering a guaranteed risk-free return of over 4% on a 10-year bond, well, capital will naturally flow out of zero-yield assets and into those bonds. It is a ruthless competition for global capital.
And right now, government debt is winning that competition hands down.
On top of that, the United States dollar index is incredibly strong, sitting at 101.367 points, which artificially suppresses global demand because gold is priced in United States dollars.
That is exactly the mechanics of it.
But hold on a minute, because this is where I have to challenge the premise in our sauces. The data is completely contradicting traditional market logic.
How so?
Well, we have massive geopolitical friction right now, particularly the recent tensions between the United States and Iran. When the Middle East destabilizes, gold is supposed to skyrocket as investors seek a safe haven. Help me make sense of why a major geopolitical conflict suddenly equaled a gold crash this time around.
It is a great question. The traditional safe haven narrative was entirely hijacked by the mechanics of the bond market.
Hijacked.
Yes, you have to look at the specific chain reaction that this geopolitical friction triggered. The tensions in the Middle East did not just cause general fear. They caused a very specific disruption that sent Brent crude oil prices spiking.
Right, because of the perceived threat to global shipping lanes.
Precisely. And when oil prices spike, the cost of manufacturing, transporting, and delivering virtually every good on the planet rises simultaneously.
So everything gets more expensive.
Everything. That immediate surge in energy costs terrified the bond market because it signaled that inflation was about to reignite. When the central bank sees inflation threatening to rise due to an energy shock, they are forced to abandon any plans to lower interest rates.
Ah, I see the connection now.
In fact, they have to threaten to raise them further. So the market quickly realized that geopolitical tension meant higher oil, which meant sticky inflation, which meant higher interest rates for a much longer duration.
Wow.
And as we established, high interest rates are toxic for gold. The fear of an aggressive central bank completely overpowered the fear of geopolitical instability.
That is a brilliant mechanical breakdown. The transmission mechanism went from geopolitical fear straight into energy costs, which handcuffed the central bank, which ultimately crushed the gold price.
That is the exact chain of events.
So, let us look at the shifting tides that could actually reverse this bearish trajectory. We are looking at upcoming data on oil, employment, and the overall psychology of the retail sector. Starting with oil, the Strait of Hormuz has reopened, and we are already seeing Brent crude cool down significantly to $74.7 per barrel.
Which is a massive relief for the market.
Forecasts for the rest of 2026 are actually being revised downwards.
And that cooling of energy prices is the first crucial domino that needs to fall for gold to recover. If oil stabilizes in the low 70s, it strips a significant amount of the sticky underlying pressure out of the consumer price index.
So the inflation numbers look better.
Exactly. When the July inflation data reflects those lower energy costs, the central bank finally gets the breathing room it desperately needs. They can pivot away from their aggressive hawkish stance, which immediately relieves the downward pressure on zero-yield assets like gold.
But before we get to the July inflation print, we have a massive hurdle to clear this week. And that is the United States employment data, the jobs report.
A huge data point.
It feels like we are in this deeply perverse economic cycle where bad news for the working public is actually good news for the financial markets.
It is a twisted logic, I agree, but it is exactly how the macroeconomic machine operates. The jobs report is the ultimate gauge of consumer demand. If a report comes in strong, meaning companies are actively hiring and paying higher wages, well, those workers have more disposable income.
Makes sense.
They spend that income on services, travel, and goods. That high consumer spending keeps services inflation incredibly hot. If the economy is running hot, The central bank has absolutely no justification to cut interest rates.
Right.
The dollar stays dominant, and gold suffers.
So mechanically speaking, gold investors are actively rooting for a weak jobs report. They need to see hiring freeze and unemployment tick up because that proves the economy is slowing down, which forces the central bank to intervene and cut borrowing costs.
It is entirely binary, yes.
But while we wait for these macroeconomic data points to drop, I want to look at what the actual human beings trading this market are doing. Because there is a fascinating report from the Financial Times noting that everyday retail investors are simply capitulating.
It is quite severe.
They are abandoning gold entirely. We're seeing exchange-traded funds backed by physical gold suffer 2 straight months of heavy, sustained outflows. Instead, retail money is desperately rotating out of precious metals and chasing the massive momentum in artificial intelligence and space exploration stocks.
And, the psychology driving that rotation is completely understandable. We're looking at a market where retail investors have endured 4 grueling months of steady losses in gold.
It is exhausting for them.
It really is. When they look across the aisle and see technology companies doubling their market capitalization in a matter of weeks, the fear of missing out becomes overwhelming. Ole Hansen from Saxo Bank published a note recently describing investor psychology in the precious metals sector as incredibly fragile.
Fragile is the perfect word. People are so exhausted by the downward grind that they are no longer buying the dip. They are selling the bounce. Whenever the price rallies by $20 or $30, they view it solely as an opportunity to liquidate their positions at a slightly less painful loss.
And that behavior creates a self-fulfilling cycle of suppression. Every time the market tries to build upward momentum, a wave of exhausted retail sellers steps in and flattens the rally.
So what breaks the cycle?
For gold to actually break this fragile psychological mindset, it cannot just bounce off algorithmic support at $4,000. It must break through and sustain a position above $4,100 per ounce.
Ah, 4,100.
Yes, that is the technical confirmation level that proves the selling exhaustion has finally ended. Until it holds above 4,100, the broader market will continue to view any upward movement as a dead cat bounce.
A brutal environment for the short-term trader. But let us pivot our focus from this immediate pessimistic winter and look at the long-term horizon, because the institutional analysis provides a completely different perspective.
A radically different perspective, yes.
Despite this gloomy quarter, major financial institutions like UBS are maintaining a highly positive 12-month outlook for gold. Now, it seems daft at first glance to be bullish when retail investors are fleeing in droves and the central bank is threatening rate hikes. Why are the institutions so optimistic?
Because the massive institutional players are looking at the structural foundations of the global monetary system. They are ignoring the day-to-day noise of retail sentiment. There are 2 colossal pillars supporting gold over a multi-year horizon.
Okay, what is the first one?
The first is sovereign demand. Central banks around the world, particularly in emerging markets, are continuing to purchase physical gold at an unprecedented historic pace.
Just buying it up quietly.
Very quietly. They are systematically diversifying their national reserves away from the dollar to protect themselves from Western financial sanctions and currency volatility. When the largest, most well-capitalized entities on the planet are quietly hoarding a finite physical asset, regardless of the daily spot price, it creates a formidable, unyielding floor underneath the market.
They're acting as the buyer of last resort.
Exactly.
And the second pillar.
The second pillar is the inescapable mathematics of the national debt. The interest payments required simply to service the existing sovereign debt are becoming entirely unsustainable.
Right.
Over the long term, structural analysts understand that the financial system will eventually require either a significantly weaker currency or drastically lower interest rates just to prevent a sovereign default. Both of those eventualities represent absolute rocket fuel for gold. The short-term pain of high interest rates is masking a long-term debt reality that mathematically heavily favors hard assets.
That tension between short-term rate policy and long-term debt reality is fascinating. But the sources also outline some highly specific wildcard scenarios. These are sudden, seismic shocks that could bypass all the technical charts and trigger a massive gold surge overnight.
The black swan events.
Right. The one that stands out to me as utterly fascinating is the possibility of the government actively revaluing its strategic gold reserves. We rarely hear about this. How would that mechanism actually work in practice?
It is a mechanism that has historical precedent, though it sounds radical today. Currently, the government holds thousands of tons of physical gold in its strategic reserves.
Some knocks and the like.
Exactly. However, on the official sovereign balance sheet, that gold is accounted for at a statutory price that was set decades ago. It is usually around $42.22 per ounce.
Wait, really? $42?
Yes, it is a completely artificial historical book value that completely ignores the current global spot price.
Right, so they are holding an asset worth hundreds of billions of dollars, but on paper, they're pretending it is worth a tiny fraction of that.
Exactly.
Eh.
Now, if the government found itself facing a severe debt crisis or collapse in bond market confidence, the Treasury could theoretically execute a statutory revaluation.
Okay.
They could declare that the gold in their balance sheet will now be marked to a market value of, say, $8,000 per ounce. By changing the accounting standard, they would instantly create trillions of dollars in new, unencumbered equity on the national balance sheet out of thin air.
Wow.
This would drastically lower their debt-to-equity ratio and allow them to issue new currency against that revalued gold without technically increasing the debt burden.
That is an astonishing accounting maneuver. And if a global superpower suddenly declares to the world that gold is officially worth $8,000 an ounce to balance its sovereign books, well, the open market price would violently gap upward to meet that new reality instantly.
It would be an overnight repricing of the entire global monetary system. Now, that is a wild card. It is an extreme tail risk scenario.
Yeah.
But it is mechanically possible, which is why institutions keep it in their risk models.
Other wildcards mentioned include a sudden sovereign bond crisis where investors lose faith in government debt entirely, or the implementation of new, aggressive global trade tariffs that choke supply chains and cause widespread economic instability.
All very plausible triggers.
But setting those extreme scenarios aside, when I look at the current market, it feels a bit like trying to build a solid foundation in a bog. You keep chucking money and materials into the hole, and it just seems to sink out of sight. It feels hopeless.
It is a painful process for investors.
But eventually, those materials hit the bedrock. You cannot see it from the surface, but the foundational work is being done, and suddenly the structure begins to rise above the mud. That is what June and July feel like to me. A messy, miserable process of finding the fundamental bedrock so the market can build a proper recovery heading into September.
That is a very pragmatic way to visualize market consolidation. Finding that bedrock is a painful process of shaking out the weak hands and transferring the asset to those with stronger conviction. But, surviving that process requires strict discipline, which brings us to the most vital part of our analysis, the specific strategy for you, the listener, on how to navigate this volatility.
Exactly. We can talk about macroeconomic theory all day, but knowledge without application is just academic noise. Let us get down to strategy, starting with the day traders. The folks trying to actively surf the daily volatility.
My explicit warning to short-term traders is to step away from the terminal right now.
Just walk away.
Yes, the intraday swings from $3,950 to $4,040 look tempting, but the reliable profit margins are incredibly narrow, and the risk of getting caught in a sudden violent downdraft is immense. Do not chase today's slight algorithmic rally thinking you have perfectly timed the bottom.
Right.
The overarching trend is still aggressively downward, and fighting the trend in the short term is a reliable way to destroy your capital.
A fair warning. Now, what about the long-term accumulators? The listeners who are looking to build generational wealth over the next 10 or 20 years, who see this drop as an opportunity.
For the long-term accumulator, crossing the $4,000 threshold is fundamentally a very solid entry point. However, your capital deployment strategy is paramount here. You must divide your available capital into smaller tranches.
So pace yourself.
Exactly. Do not take your entire cash position and execute a single massive buy order today just because the price hit a psychological round number.
So we are talking about the mechanics of averaging down. If you divide your capital into 4 parts, you deploy one tranche today at $4,000. If the market continues to slide and hits $3,800 next month, you deploy the second tranche. Your average entry price automatically adjusts to the middle, smoothing out the volatility and removing the emotional pressure of trying to catch a falling knife.
Precisely. Averaging your entry price is the strongest defense mechanism you have against short-term algorithmic volatility.
And what is the guidance for the current holders? The investors who perhaps bought into the hype back in January when the price was near $5,595 and are now staring at their portfolios feeling properly sick.
The consensus from the institutional analysis is clear. Do not panic sell during these summer doldrums. If your original investment thesis was to hold this asset for 5 to 10 years as a hedge against currency debasement, the daily algorithmic fluctuations of June 2026 are ultimately irrelevant noise.
So just sit tight.
Sit tight. Liquidating your position now simply locks in a permanent loss driven by temporary interest rate fear. The structural pillars supporting your original thesis remain entirely intact.
And there is one final, ultimate warning we must deliver to everyone, regardless of your time horizon or strategy. Avoid using high financial leverage.
I cannot emphasize this enough. Utilizing borrowed money or margin leverage in a market this fragile and headline-driven is financially reckless. Prices right now can reverse violently based on a single unexpected sentence from a central bank official during a press conference, or, a minor surprise in the upcoming jobs report.
It happens in the blink of an eye.
Exactly. If you are highly leveraged, a temporary dip that lasts only 30 minutes can trigger an automated margin call and completely wipe out your entire account before the market even has a chance to recover. Keep your position sizes manageable and fund them strictly with your own settled capital.
A sobering but absolutely necessary warning for anyone operating in these conditions. Right then, let us summarize exactly what we have uncovered in this deep dive. Today was an exhausting, brutal tug of war at the $4,000 per ounce mark. The market is being heavily suppressed by a strong dollar and the relentless fear that the central bank will be forced to keep interest rates punishingly high to fight sticky inflation.
That is the core of the current pressure.
We have seen retail investors completely capitulate, pulling their money out of physical exchange-traded funds to chase the momentum in the technology sector. However, beneath this deeply gloomy surface, the fundamental bedrock for a late-year recovery is quietly being laid. Cooling oil prices are paving the way for softer inflation data, and sovereign central banks are continuing to accumulate physical metal at an astonishing, historic pace.
The tension in this market is palpable. We are essentially watching a high-stakes waiting game to see which underlying force breaks first, the resilience of the employment market or the resolve of the long-term institutional gold investors.
Which leads me to a final provocative thought I want to leave you with. Something to properly mull over as you watch the charts develop this week. We discussed how retail investors have completely drained their capital out of gold to frantically chase the artificial intelligence stock boom.
We did.
But I want you to consider the mechanics of a sudden reversal. What happens to the price of gold if that wildly overextended artificial intelligence technology bubble pops at the exact same moment the central bank finally decides to cut interest rates? You would have a massive wall of panic-stricken retail money fleeing the stock market, colliding instantly with a fundamentally friendly, low-interest rate environment for gold.
A perfect storm.
Exactly. It is a potential double catalyst waiting in the shadows, and if those two events align, it could aggressively rewrite the entire landscape of the market overnight.
It is a convergence scenario that every serious structural analyst is keeping a very, very close eye on right now.
Something to think about indeed. Well, that brings us to the end of our bulletin. Thank you again to our expert for the brilliant, grounded insights.
My pleasure. Thank you for having me.
And thank you to you, the listener, for spending your time with us and engaging with the material. If you found this deep dive valuable in cutting through the noise, please do not forget to like the video, subscribe to our channel, and leave your thoughts and theories in the comments below. We wish you a very peaceful evening and clear-headed investing.